The video opens with a fast-paced montage of historical black and white footage of the 1929 stock market crash, juxtaposed with modern, sleek shots of today's digital stock tickers and trading floors. The music is tense and dramatic. Is history repeating itself? We often hear that phrase, but what if I told you the ghost of the biggest financial meltdown in history, the Great Crash of 1929, is looming over us right now? And what's scarier? Almost nobody seems prepared for what might be coming. Hi everyone, and welcome back to the channel. Today, we're diving deep into a topic that's both fascinating and, frankly, a little unnerving. We're going to explore the striking parallels between the Roaring Twenties and our current economic landscape. By the end of this video, you'll understand why some of the world's top economists are looking at today's market and seeing the eerie reflection of 1929. Stick with me, because this isn't about fear-mongering. It's about being informed and prepared. So what exactly happened in 1929? Let's take a quick trip back in time. The 1920s, much like the 2010s, were a decade of incredible technological innovation and economic optimism. Radio, automobiles, and airplanes were the hot tech of the day. Much like AI, EVs, and social media are for us. This excitement fueled a massive stock market bubble. Everyone, from Wall Street tycoons to everyday shoeshine boys, was playing the market. People were borrowing heavily to buy stocks, a practice called buying on margin. The belief was that stocks could only go up. Does any of that sound familiar? The party came to a screeching halt on October 29, 1929, a day now known as Black Tuesday. The market completely collapsed. Fortunes were wiped out in an instant. This wasn't just a bad day on Wall Street. It was the trigger for the Great Depression, a decade of worldwide economic hardship. Now, let's fast forward to today. Look around. We've just come through a period of unprecedented market growth, largely driven by tech stocks and fueled by historically low interest rates. Sound familiar? We've seen a surge in retail investing, with people using user-friendly apps to trade, sometimes with borrowed money or on speculative assets that have little intrinsic value. This is the modern equivalent of buying on margin in the 1920s. There's a widespread belief, especially among a new generation of investors, that stonks only go up. This is what analysts call irrational exuberance, the very same sentiment that defined the Roaring Twenties. Let's break down the parallels even further. First, market concentration. In the 1920s, a handful of powerhouse companies like Radio Corporation of America dominated the market. Today, our market is heavily influenced by a small number of tech giants. You know their names. When these few companies do well, the whole market looks healthy. But this concentration creates a huge vulnerability. If just one or two of these giants stumble, the ripple effect could be catastrophic. Second, the wealth gap. The 1920s saw a massive disparity between the ultra-rich and the average person. The gains of the economic boom were not evenly distributed. Today, we're facing one of the widest wealth gaps in a century. While the stock market has created incredible wealth for some, many people are still struggling with stagnant wages and rising costs of living. This kind of inequality makes the entire economic system fragile. When a downturn hits, the majority of the population has no financial cushion to fall back on, which can turn a market correction into a full-blown economic crisis. Third, global instability. The period leading up to 1929 was marked by complex international debts and trade imbalances left over from World War I. Today, we're navigating a landscape of geopolitical tensions, ongoing trade disputes, and a global supply chain that we've recently discovered is incredibly delicate. An unexpected shock anywhere in the world can have immediate and severe consequences for the global economy. So, if the similarities are so clear, why isn't everyone prepared? There are a few reasons. One is what psychologists call recency bias. We tend to give more weight to recent events. The market has been so strong for so long that many people, especially younger investors who didn't experience the 2008 financial crisis, find it impossible to imagine a severe, prolonged downturn. They've only ever known a market that bounces back quickly. Another reason is the sheer complexity of our modern financial system. Derivatives, high-frequency trading, cryptocurrencies, these are all elements that didn't exist in 1929. While they can create opportunities, they also add layers of risk that are not fully understood, even by experts. It's a black box And we don't know what might happen if one of these complex systems fails under pressure. So, what does this all mean for you? Now, this is not financial advice, and you should always do your own research. But the goal here is to empower you with knowledge. The first step to being prepared is simply being aware of the risks. Don't fall for the get-rich-quick hype. Understand that markets are cyclical. They go up, but they also go down. Diversification is key. The old saying, "Don't put all your eggs in one basket," has never been more true. Spreading your investments across different asset classes, industries, and even geographical regions can help cushion the blow if one part of the market takes a hit. Think long-term. Panic selling is often the worst thing you can do in a crash. If you have a solid, long-term investment strategy based on strong fundamentals, you're better positioned to ride out the storm. The market has always recovered from every crash in history, eventually reaching new highs. The key is having the financial and emotional stability to stay the course, and finally, build a financial safety net. This is crucial. Having an emergency fund with several months of living expenses in cash can be the difference between weathering a downturn and facing a personal financial crisis. It gives you options and prevents you from being forced to sell your investments at the worst possible time. Look, nobody has a crystal ball. A 1929-style crash is not a certainty. Governments and central banks have more tools at their disposal today to try and prevent a complete meltdown, but the warning signs are there, flashing brighter than they have in a long time. The story of 1929 isn't just a history lesson, it's a cautionary tale. The biggest mistake we can make is to assume this time is different. Sometimes it isn't. By understanding the past, we can make smarter, more resilient choices for our future. It's not about being fearful, it's about being wise. What are your thoughts? Do you see the parallels, or do you think the worries are overblown? Let me know in the comments below. I read every single one, and I'd love to start a conversation about this. Thank you so much for watching. If you found this video insightful and want to learn more about navigating our complex economy, please give it a thumbs up and consider subscribing to the channel. Don't forget to hit that notification bell so you won't miss our next deep dive. Stay informed, stay prepared, and I'll see you in the next video.